37 years. 37 years. I have worked with one of the best mentors a person could have. And that is a young guy, well, he's young compared to me. His name is Tom Cock, and Tom worked with me for over a decade at my old investment advisory firm. And then he set up his own advisory firm, and Don McDonald, his old buddy, worked with him, and they developed a very successful investment advisory company, and they are helping tons of people. And what makes me feel so good about it is he did exactly, or at least close to it, what I did, and that is go out and teach people for nothing. And if they don't want to do it on their own, then they're willing, Tom's firm was willing to do it just as my old firm did the same. So he has been very successful as an investment advisor. He has his Talking Real Money. Don and Tom are on our list of truth tellers. If you ever look at that list, and I have to say that Tom really changed my life because for 37 years we've been friends, and he's been teaching me about how to be better at whatever I've done on the radio, on TV, podcasting, videos. Tom was a wonderful mentor. But there are more. And boy, is it interesting and fun to look at those mentors and how they change your life. A young man, young at the time, a rich buck, 32 years ago, I offered him a job, a writing job with the Merriman Investment Management Company. And first he turned me down, and then he thought about it again and he called back and said, I'll take it. And boy, am I glad that he took it, because for the last 32 years, I've been working with Rich. He has, I've been outlining, I've been coming up with ideas, I've been an editor, but the hard work of writing has been the work of Rich Buck. And I just so honor his commitment to trying to do the best to educate you. And I've never worked well, hardly ever worked with anybody as easy to work with as Rich. I mean, he's just a dear friend. And by the way, so is Tom Cock after all of these years. Now, some mentors haven't been around that long, but the impact that they've had on me is huge. Another one, I think Daryl Balls has been part of my life for over 20 years. I don't know the exact date. In fact, maybe more than that. But he first was a client of the old firm. Well, first he was a student and would come out to my workshops, then a client at the Merriman Company, and then after I retired, he decided to come help us here at the foundation. And the work that he has done in producing numbers, tables, I love tables, but when it comes to Daryl, there are tables and then there are tables. And his tables sometimes, I'm not kidding, they just jump right out at you. They take you by the hand and they show you things that without his cleverness, I don't think people would see in those tables. Maybe I wouldn't even see them. So I feel blessed that Daryl has been here working as a volunteer for over 10 years at our foundation. And the youngest, actually, and the newest of the mentors that have changed my life would be Chris Pedersen. And Chris is here with me today. Chris has done absolutely amazing work. It just so happened, and this is Kind of like the old saying about when the student is ready, the teacher will come. And I will tell you, as a student, I suspect I was ready because when Chris Pedersen said to me and to Daryl, look, guys, all of this work with 10 funds is wonderful. And the engineers love it, and the academics love it. And of course, it's based on all this academic research. But the individual investor that you want to help as a do it yourself investor, they don't exactly love having to put together a 10 fund strategy. And it was literally within months or at least a year that Chris came to work with us that John Bogle gave me a speaking to. He said I was crazy trying to get people to deal with 10 funds. He said, if you really want to help people, you're not going to recommend 10 funds. You're going to recommend a couple of funds. In fact, there are people who do this very successfully, only recommending one fund. And so I came back from my 90-minute conversation with John Bogle back in Pennsylvania to sit down with Chris and with Daryl, and we all admitted that not only was John Bogle right, but so was Chris Pedersen, and Chris was bright enough and did the work to put together these portfolios that today a lot of people follow, whether it's the two fund strategy with the S&P 500 and the small cap value, or the four fund US, or the four fund worldwide. And I don't mean to suggest that he created them all out of thin air. As a matter of fact, somebody involved with the Bogleheads had put together something that would look like the four fund worldwide strategy that we put together. But Chris took it the next step and did the hard work of finding what he considers, and I certainly see his research and agree are the better investments to actually apply the theory to building a portfolio. So Chris has made it easier to invest for people who follow our work. And of course, he also is responsible for two funds for life. I mean, what a great strategy. The ability for so many young people, and particularly young people who are just starting out, and the fact that they're using a target date fund as their first investment is amazing because historically it normally took about a decade or more for somebody to figure out how to properly invest. But now they're doing the right thing right out of the gate, and that's wonderful. But as we all know, don't have to believe in it enough to put it in your portfolio. But I certainly believe in it, and that is that there is a place for at least some small cap value in that portfolio. And that is the two funds for life. And Chris and I will be spending another make another presentation. In fact, Chris has got a new calculator that will be for you to view here in the coming weeks. So lots going on, lots of effort by Chris and Daryl and others. And so now I am happy to be joined by Chris Pedersen, where today, by the way, Chris, you have been gone. You have been evidently having a good time. I can't remember. Have we done one of these since you got back from
No,
Greenland?
no, I think we did one in August,
Ah,
and
okay.
then we
Okay.
were off with some new friends
Yeah.
and somebody else in the industry, and having fun seeing new places. It was good times, and then just got back. I just have to say, thanks for the very gracious introduction. It reminds me that none of us are as good as the reports from our fans, or as bad as the reports from our critics. We're all somewhere in between. And I need to throw some praise back at you because I hope to be as young at heart as you are when I'm your age. There are a few environments I can get in where I'm the youngest person. So thanks for that. That's really quite a gift.
Well, I thank you, Chris, but I have a complaint. Well, you have created a small problem in our family because I have this problem with being a bit of a workaholic. And as you know, I retired theoretically about 12 years ago, and my wife really did believe that I was retiring and really did believe that we were going to spend more time together. And of course, she's had to get used to me and my mission. And then she knows now all about you and all the traveling you and Susanna do and all the time you spend with your kids. You are an amazing husband and father, and you make it very difficult as a mentor to live up to your practices. So I'm not complaining, by the way. I'm really in awe of the lifestyle that you've chosen. But now that you're back, by golly, we're going to get some questions answered. And I have a couple that are really from me. And they come because I get the question from others so often. And I'm not asking you to do a presentation on how you select all of these best in class ETFs. But can you just take a few minutes and give people a brief overview about why that you actually believe that in the future, one ETF is likely to outperform another?
Yeah, that's a great question, and I think it gets at the heart of how somebody should look at any set of fund recommendations, because I think the starting point is there is so much variability in what's going to drive performance that the odds that the recommendation from me or anybody else is going to be the best performer next year, it's pretty close to zero. There's so many funds and so much noise in the market driving what's going to do well and what's going to do poorly. So, if you're looking for what should I invest in to get rich quick, there nobody can tell you that. That's the crystal ball exercise. The best we can do is look at what's done well in the past and what the academics say has some kind of a good rationale or argument, or just good underlying reasons why it should do well in the future, and then look for funds that have those attributes. And the Nobel Prize winning work of Fama and French was some of the first work that really started to look under the hood and say, well, what is it that drives performance? And the two things they found were that the smaller part of the market outperformed, and the cheaper or value part of the market, where you pay, less of a premium for the intrinsic assets inside those companies, had also performed better. They had more risk, but they also had higher returns. And if you looked at those parts of the market, they delivered those returns not in sync with the whole market. So there was some diversification opportunity there too. And all of that led to the basic construct of the kind of portfolios that we use. All of our portfolios have more small and more value in them than you would get in a cap weighted fund at large. And that's what gives you exposure to these other parts of the market that historically delivered a little bit of a premium. And so you would expect, if you invest in that kind of a portfolio, you'd have a chance to get a higher return with a little bit higher risk. And in the work you just did, for example, with the S&P 500, comparing it to these more diversified portfolios, what you showed is that if you diversify in this way, you can add some bonds back in and get the same kind of return you got with the S&P 500 at lower risk. So you've got these really interesting knobs and levers. Well, when I look for a fund, I'm looking for a fund that has the same kind of attributes that the academics say lead to a higher return per unit risk. I'm looking for funds that are a little bit smaller within their category, a little bit more value within their category. And with time, I've been able to also find funds that have a little bit more quality, a little more profitability, a little better investment exposure, a little better momentum. And so you take a fund that is firing on five cylinders instead of two or one, and you have a higher likelihood it's going to deliver the premiums you hope for in the future. Now, it might take 10 years, it might take 15 years, it might take quite a while for those premiums to show up. But I believe that following that academic set of arguments, looking under the hood, trying to figure out whether these funds consistently deliver exposure to the attributes that historically have delivered good returns, that's a great rational way to pick funds. And I also look at turnover, tax efficiency, expense ratio, number of holdings, because you'd like to have a fund that is cheap, delivers all of the attributes you want, has thousands of companies instead of tens, is managed consistently over time, is tax efficient, all of those things. You can't get everything you want. In fact, one of the interesting things is the more you stretch and reach for one attribute, the more you have to give up some of the others. And so you try to get the one that has the best combination. And that's really what the math behind what I do is trying to get at is which of these funds has the best chance to deliver a premium consistently in the future. And in the latest iteration, I added kind of relative numbers to say, are we talking about a 1% difference in performance, a 5% difference in performance, a 0.1% difference in performance? And so people can look at that too, and that will give them an idea that in some of these categories, choosing best is more valuable than in others. Because in some of the categories like US large cap blend, you can find 10 funds that are all going to be within 0.3%, 0.5% of each other over the next 5 years. And they'll wiggle up and down, but they're all going to be really, really close. But when you get into small cap value and international funds, then they spread out a little bit more, especially in the smaller parts of the market. So I think, you've said in the past, it comes down to what you believe in and can stick with. And so I don't know whether that argument's going to hold water and convince everyone. It obviously won't. There'll be people who are swayed by something else, like Morningstar's star rating,
Yeah.
which tends to rely more on recent historical performance. It's very important you figure out what you believe in and what you can invest in with conviction. So it may or may not be the way I do it. It might be the way somebody else does it.
Well, I will tell you that if we look at IWN, which is a small cap value fund that has been around, replicates the Russell 2000 small cap value, and it's been around for over 25 years. And if you compare the return of that portfolio compared to the return of the DFA portfolio. Now, uh, to be fair, the people at DFA are actually the source of where you've learned some of the stuff that you've learned, I suspect.
Absolutely. Yeah.
And so we can see in the performance of their small cap value fund that's just a little over 25 years old, its performance has been virtually almost double that. I'm talking about the impact of compounding, but its performance has virtually been half of what you
That's
put in there.
IWN has been half of what DFA has done.
Yes. And that's over a 25-year period. And so while I'm hoping to get another 5 years out of my life, I'm hoping there are a lot of you that are hoping to get another 25
Or more.
and or more. That's right. And I found out something else today. I mean, every day there's something to learn. While I was looking at some of these small cap value funds, looking for some differences that would be important in terms of wanting to believe that a regular index fund is better than one that is being managed in a different way, a particular way to be better. I mean, only to be better. That's the reason they do it. They don't do it for fun. But one of the things they do to make it better, and you're taking into your analysis, is the quality of the companies on average, of course, not one at a time, but on average versus another. And here's something I saw this morning that the bottom line is it's about quality. And I believe it was the growth of the book value. It's the last item that you see on the box that shows all of the measures, like the PE ratio and the book to market ratio. The last item shows how that those companies are growing or not growing. Now, for the fund that I was looking at, and I believe it was the DFVVX, which is the dimensional funds fund that's been around for many years, but I believe it was at an 8 or 7+% growth rate. Now, I had no idea what that meant in terms of how did that look compared to what others looked like. So I looked at IWN, a negative 21% a year, a negative 21% a year. And then a fund that has a better return than IWN, VIOV, that's a Vanguard fund. It was a 3% plus. So all of these things can be carefully measured. What you can't carefully know is what will happen after you measure them. And as you say, Chris, you don't know what's going to happen next. But it does bring up a terribly difficult question because I talked this last week about the equal weighted portfolio, S&P 500 portfolio at Invesco. And that's not the only one, by the way. You can get others, but the returns are similar because they're basically trying to do the same thing. But here's what I know, and I don't know exactly how to deal with this. I know that for the last 15 years, and I've got the number here, that with that Invesco equally weighted S&P, that means that instead of being cap weighted, and having a whole bunch of money in Nvidia and a whole bunch in Microsoft and a whole bunch in Facebook, etc., that you have the same amount in every stock. All 500 companies are represented, but they each have an equal amount, which means you're going to have smaller average size companies and you're going to have more value in that portfolio than you will in the cap weighted. So what did I see when I went to Morningstar? Well, the the one that is equal weighted, compounded at 12.1% over the last 15 years through yesterday, the 9th of October. And the S&P 500 compounded at 14.4. And I'm saying that you would make more money in the future, likely in the one that has the smaller and the more value. Yes, I believe that. But in order to see that, 25 years, you have to go out 25 years because at 25 years, the S&P 500 compounds at 9.3 and the equal weighted S&P at 9.4. And we've talked a lot about an extra 0.5% or an extra 1%. It's a life-changing amount of money for a lot of people over a lifetime, particularly if you start when you're young. But Chris, my question for you, and it is a big one for all of us. What performance should I trust or believe or whatever that word is that would make you say to me, Paul, you'd be better off in the equal weighted S&P 500 than the regular cap weighted. But you most likely would say to me, but before you do that, realize that your portfolio is basically set up like that with half in large and half in small and half in value and half in blend, etc. But if somebody wanted to have a single fund that was likely to do better than the total market index or the S&P 500 in the future, the question is, how do you choose between the 15-year return and the 25-year return in making your decision?
Yeah, investing, one of the hardest things about investing is that it's so easy to learn the wrong lessons. Um, in most of our day-to-day life, you can learn moment to moment, minute by minute, how to balance, how to stand, how to walk, how to talk. The stove is hot. You learn that in an instant, right? You don't have to wait a long time to learn these lessons. Uh, Finance is not built for the timelines that we learn on biologically. The truths in finance tend to come out over decades. And I think one of the things that helps, other than stretching the timeline, right, going out to 50 years, most of our back tests are to 1970. So we're getting close to 55 years now. And some of them go back to 1928. So I think stretching the timeline gives you something that you can have more confidence in. We also use rolling periods of time. Almost everybody who does back testing thoroughly does that. So you don't just look at the whole time. You say, well, what happens if I look at every 30-year rolling period of time? And that gives you greater confidence. I think the other piece that's really important is understanding what's behind it. Why should smaller companies do better? Why should cheaper companies do better? Why should companies that have more better financials do better? And if somebody wanted to get grounded in that, I think Larry Swedroe's book on factor investing is a great place to go as a start. But you could also read all of the material that comes out of Avantis. Avantis publishes all kinds of material about their funds, and they do a fantastic job educating. DFA does as well. Both of them have a lot of really good material to give you confidence that you shouldn't follow, for example, Big Earn's advice when he says, you know what, the small value premium is gone. You just look at the last 15 or 20 years. It's no longer there. And there's two conclusions you can draw when you see that. One conclusion is the premium's gone, it's never coming back. The other conclusion, which is backed up by these rolling periods of time in history, is that usually a period of time of underperformance is followed by a period of time of outperformance, not immediately, but eventually. And so if you ground yourself in some of the reasons why, that last thing I talked about is called reversion to the mean. The reason small companies tend to grow more is that they have more room to grow. When you get to be the size of NVIDIA, it gets really, really hard to grow because you're already so big. It's easier to fall than it is to grow. It's easier to take a company that has a cheap price and see it outperform in the future than one that has a very, very expensive price because it's priced to perfection. So there's underlying reasons, and I think those are all really important. Going back to your point about the Russell 2000, why would a fund based on a public index that has its rationale out in the open underperform one that is managed with a private methodology that doesn't have to rebalance on a particular timeline? That's a no-brainer. It's straight up, if you tell the world you're going to trade on a particular date, everybody can front run your trade. They can go, oh, you know what? They're going to have to buy a bunch of this tomorrow. I should buy some a week in advance or a month in advance, right? So people who are using public indexing or, publicly available indices that have these published dates on which they have to rebalance and change things are operating with one hand tied behind their back. It's no wonder they have underperformed. And that's one of the reasons I kind of bristle at the conventional advice of only investing in index funds, because historically that would have ruled out DFA and Avantis. Yet if you look at DFA and Avantis, they manage their funds as an index. They're very systematic in their approach. There's not a lot of emotion. There's not market timing or second guessing. Yet the fact that they're doing it on their timeline without telegraphing to the world when they're going to do it, that gives them another percentage or two opportunity to deliver return to their customers. So I think, yeah, it's really important to understand the whys and the hows. You also mentioned the equal weighted fund, and it's not surprising on a very long timeline that it outperforms, because much like the old New York, was it Wall Street Journal articles where they did the monkey dartboard
Yeah.
portfolios, right? Years and years ago, they would choose at random as if they were a monkey throwing darts, a set of stocks, and they would often outperform the cap weighted index. Why? Because when you randomly throw darts, you got a better chance of picking smaller companies and ones that are cheaper and out of favor than if you do cap weighted, which is going to heavily weight all the stuff that's growth oriented and giant. So, the equal weighted fund is basically the dartboard exercise, but limiting yourself to the top 500 companies. So it's not surprising that it would outperform. The trade-off, though, one of the problems with that approach is that if you want to be equal weighted, and that means about 0.2% in every holding that you have, if you have 500 holdings, tomorrow when the stock prices change, you got to trade. You don't necessarily have to reconstitute every day, but every quarter you're going to have a lot of things that moved up and down, and so it has a high turnover. It's about 25%. So that 25% turnover is a bit of a tax and a drag on the historical performance of that fund, where if you do it the way we do it, where you buy a small cap value fund and a large cap blend fund, you have far less turnover in each of those funds individually, and you just rebalance annually or when you want to. So it's more efficient, much more efficient. Yeah.
Plus, the tax cost. Now, I find this fascinating when people ask, should I be in an ETF or a mutual fund? The tax cost per year over the last 3 years, according to Morningstar, of that equal weighted mutual fund at Invesco was almost 2% a year. So if you made 20%, then after taxes you actually made 18. And I think they use the highest tax rate to figure that. But the bottom line is you lose a lot. On
Yep.
the other hand, if you buy the ETF that has virtually the same return, penny for penny almost, the tax cost is about a half of 1%. And that difference is because of the way an ETF the taxes are determined. And so if you are in a taxable account, we are not recommending that you move your money from Vanguard 500 to Invesco's equal weighted. But in a tax deferred account, I would not see that as a terrible thing to do. Of course, we would actually rather have you be very efficient and have a part of your money in the large cap blend, cap weighted, and part of it in small cap value. And by the way, I'm curious in terms of combination of those two, for the person who is comfortable owning the S&P 500 in terms of their risk tolerance and their tolerance for volatility. Chris, about how much small cap value do you think, if you had to take a guess at what would be appropriate for somebody to add to that portfolio, that it wouldn't give them sleepless nights, what would that percentage be?
I think that entirely depends on the individual. Some people, if you follow our recommendations, you'd go half and half. You'd do half in large cap blend, the S&P 500, and half in small cap value, and you'd end up with a portfolio that had some strong sauce tilt to small in value, but it would still have a lot of the characteristics that your ultimate buy and hold portfolio has. It's half in large, half in small, half in blend, half in value. And so the performance should be a little bit higher just because you're averaging out large cap blend and small cap value, and small cap value has a higher expected return than small cap blend or large cap value. So it would give you just a hair more expected, but they're fundamentally the same kind of portfolio. They're very broadly diversified. Yeah, so somebody could go up to 50%, but there will be people who are going to get really nervous 5 years down the road if the small cap value is lagging the market. And for them, that's part of the reason in our two fund for life strategies, we recommend start with 10%, start with 20%. And one of the great things about target date fund investors is that they tend, because they can automate it and they're busy working, they tend not to trade when the market's down. They tend not to look at their assets and get skittish because one lagged a little bit or one was ahead by a little bit. And so I think there's a great possibility that somebody who sets their portfolio on 20%, 30%, 40% small cap value and the rest in a target date fund will be able to stay the course because they're probably going to put it on autopilot. It's going to be going on in the background, and they're going to be very happy with the balance growing over time because one of the two will be doing well and they will be contributing money regularly. And that's going to soften the blow of market downturns. And they're going to be more like Rip Van Winkle. They're going to look away for long periods of time. And that's all fantastic. But yes, it's very important to right size that investment. And the calculator we talk about next week, and I don't know if it'll go out to your audience next week or maybe in a couple of weeks, but it will let people play with that. It'll let people play with, do I want to be, and if you think about it, a target date fund in its early years is similar to S&P 500, except it's more internationally diversified. It's got some US and international stock in there. They'll be able to play with what happens with 5%, 10%, 15, 20. Yeah.
Great. So we're going to have a link, Chris, to your page of recommended ETFs. And I think it'll all be fairly clear. And of course, we have another page where we give you we'll have a link to all the portfolios that we have. The two fund, the four fund, they all value the worldwide this and that. So people can not only see how those are built, but then we'll also have a link to the tables that show the returns of all of these strategies looking back to 1970 and the risk. That's so important. The only part on that page of recommendations that to me, if you're going to be looking at it intuitively, you're going to see one small cap US value, one international small cap value, one large cap. I mean, you're going to see one of each until you get to the emerging markets. And you have three different recommendations here, listings of emerging market funds. You want to take a second and explain that?
Sure. So the portfolios that we recommend have one allocation to emerging markets, and that's expected to be emerging markets blend or just emerging markets. And our recommendation there is the Avantis AVEM ETF. But there's other recommendations in there. There's one for DFA that is in second place, if you will. And we think both of those fund families are fantastic. So both would make good choices. We also have an emerging markets large cap value and an emerging markets small cap blend fund recommendation, partly because they're available. There is an Avantis emerging markets value and a DFA emerging markets value, and there is an Avantis emerging markets small cap blend that are both in that set of recommendations. They're there primarily because somebody who looks across their portfolio and wants to get a little bit more complicated and be more consistent with this idea that you're half in large, half in small, half in blend, half in value, they could go in and take their emerging markets and split it that way. Or if somebody's in an all value portfolio, they could choose the value fund for emerging markets. If somebody wants to be in a all small value, you could combine some of the large value and the small blend and try and kind of approximate that. So they're not part of our fundamental normal portfolio recommendations, but they're there for people who are interested in introducing some tilt to small in value in their emerging market holding.
Okay, that's great. And I know we've been talking a long time here, Chris, but I want to take a few that came from the outside folks who were watching this. Here's one that talks about putting all your eggs in one basket. Somebody's a little uncomfortable having all of their investments under the umbrella of Avantis. And maybe make it very clear. We are not recommending you go put all of your money at Avantis, but rather to go to a Vanguard or a Fidelity or a Schwab or other firm, a brokerage firm like that, preferably one that offers free commissions to buy and sell those ETFs, but to own those and hold those ETFs at Avantis or DFA funds or whatever we recommend. But the question is, should a person be nervous about having too much money under the umbrella of Avantis management?
We used to get this question more in the past when Avantis was new and they were small. It's important to remember they're part of American Century Funds, which is a bigger company. So they have that backing. And the other thing is that when you own a fund like that, the funds are held by, is it a custodial company, right? It's not like Avantis could turn around and sell your funds because they were going bankrupt to pay their creditors. That can't happen. The funds are a collection of assets that are held for your benefit. And even if the company that manages those funds goes out of business, the worst that can happen is they can distribute to you the holdings in a mutual fund. I don't know if that can happen in an ETF, but you're not going to lose your investment. It might get messy because it comes to you in, some set of stocks, but even that is very rare because usually what would happen is the fund would be absorbed by a different fund. and typically that fund would have a similar management philosophy so that it reduces the amount of people who head for the hills because they don't want to lose their assets under management either. So I think the risk is very small. Paul, you used to manage a company where most of your recommendations were in DFA. How did you answer that question when people would ask you about DFA?
Well, to begin with, the question about anybody and the work they do in on Wall Street, if you want to call it that, there's always a lot of question. Can we trust them?
Yeah.
I think Vanguard and John Bogle earned a whole new level of trust from the public. And I must say there are a lot of people these days that have complained about their back office, and but I haven't heard that complaint recently. Maybe they've fixed that problem, but that is the kind of thing that can make people go away rather than the fear of whether Vanguard is going to be there. But I think they have almost $7 trillion under their management, so they're gigantic. The thing I like about DFA, and there's a wonderful, wonderful video, I think it's called Turn Out the Noise or Turn Off the Noise,
Tune out the noise.
tune Out the Noise, yeah. And it's about the growth of DFA. And when I talk to young people about investing in stocks, I don't want them to be thinking about stocks like something you buy to sell and to trade. I want people to be thinking about those companies inside of the mutual funds like Vanguard and DFA and Fidelity and others, that you own those companies and
Yeah.
what they're doing to build for a better future. And that every one of those companies is having their own struggle, regardless of how successful they look on the outside. Somewhere they're having struggles and trying to make life better for the shareholders, for the employees, for the directors. It's a big effort, but it's about one company at a time. And the beauty of that, I thought, of that video about DFA, they started on a kitchen table. I mean, literally, they started on a kitchen table and they have ended up being, I think they have 800 billion under management now. They are one of those amazing stories that you like to think about that you're going to own some part of it. Now you they're not public, by the way, so I'm not recommending their stock. But what I'm saying is they represent the same kind of wonderful company that we want to be part of. And so the other part, other than that, I trust them as a group and I trust their morality. There is no, in my mind, there's no mutual fund company any more dedicated than Avantis and DFA to doing the right thing. I'm sure there are others that are equally dedicated, but they really are trying to do everything right. Having said that, doing it right doesn't mean you make the most. That is yet to be determined. But I do believe that the laws and rules around investing are such that the risk, as you've said, Chris, the risk is very, very small because DFA doesn't own any of those companies. The shareholders own those companies that they hold inside those portfolios. And yes, they're in a trust bank overseen by a custodian. I mean, all of these defenses against people somehow getting their hands on that money and ripping them off. And from time to time, and it's really rare, some tiny fund figures out a way to take advantage of people. And the minute they're found out, they are, to the best of my knowledge, uh, made to make things right, or they go out of business. They put them out of business, make them merge with somebody else, like Chris mentioned. So I think DFA Avantis will be just fine. The big risk you take as an investor is the market is going to go down 50%. Forget about the risk of whether your account at Vanguard is okay, or at Schwab, or wherever you have these funds. The big risk is when the market goes down, and from time to time, that's what it does. In fact, as I looked back to 2000 and then went forward year by year until the end of September of 2025, I noticed that, boy, if you wanted to be in a hot stock, a hot fund, the Fidelity Technology Sector Fund for 25 years prior to 1999 compounded at over 18%. So you can understand why in 1999 people thought that folks were going to make a lot of money from 2000 to 2010. In fact, it took until 2012 or 14 for you to even break even from where you were if you put money in on December 31, 1999. And it didn't just go down a little, it went down over 80% before it turned around and went back up. And on the other hand, during that same period of time, the technology was struggling. And here we go, Chris, with that reversion to the mean stuff. But the small cap value had a big profit. I think it was 20, 30%. I mean, it had more than doubled over that period of time. So this is why it's not easy to be an investor, because the path is not constructed in a way that you have much control. Expenses, you got control. Diversification, you got control. Indexing versus active, you got control. How much in stocks and how much in bonds, you are on top of it. You can control what that percentage. You can control whether the bonds are high yield or high grade or government. All of those things in your control. But the one thing that we get asked the most about in the future is, well, how much money do you think I'm going to make? Well, as much as the market will make. And what we want you to do, and this is the whole idea behind indexing, we want you to capture that market return and not lose it to expenses or bad behavior. And by the way, the bad behavior historically has a greater negative impact on your portfolio than the bad expenses. So we want you to work on all of that to become the best investor you possibly can. And you know something, Chris? I can't say we've worn out our welcome, but I think we've shared enough for the day. Thank you for
I just want to add one last thing you can
sure.
control based on what you said about being an owner, not a speculator. So the market goes up and down based on a combination of earnings and sentiment. In the long run, earnings wins out. But in the short run, sentiment drives the news and it drives where things go. So when the market is down, it's important to remember that it may have dropped by a factor of two, but the earnings of all of the companies very rarely ever drops by anywhere near that much.
Yeah.
You still own these companies that can deliver those earnings. And that's the real engine that drives your future return. And so that owner perspective can help you, I think, temper or calm your nervousness in bad times, because it reminds you that what I own isn't some speculative, just, Bitcoin, whatever price people think it's worth today. I own companies that are delivering something valuable. And they might be cheaper today, and maybe that means I should buy more of them. But it doesn't mean you should sell them, because that earnings tends to be a lot more steady and a lot more growthy over time. So I love that earnings perspective. I had lunch with a friend recently who is deep into real estate investing because it's tangible. And he said, the market is just so fuzzy, I don't get it. It just seems like this airy-fairy, who knows why it's going to be worth more tomorrow thing. And I said, well, you realize you own companies when you buy the market, right? You own some of McDonald's and Amazon and Nvidia, and that you own something meaningful and substantive. And he had to actually pause and internalize that. I think it's a hard thing and he's been a stock investor or mutual fund investor probably for 20 or 30 years, and he's still learning it. It's a great guy.
Uh, Great comment and really important. I think it helps people understand why and how they should become a buy and hold investor for the long term. I hope so. And share this, if you will, with friends and family. And it's helpful to us if you subscribe to our channel on YouTube. It helps us when you give us a thumbs up. All those things are grades by the people who track these things, and the more of those grades we have, the more likely that we'll make it higher in the list of shows and imprints, et cetera, that all of us are after. And to the extent that you have a question or a comment about our work, when you put that on the comment section, in the comment section of YouTube, I will answer it, and it will help others. And if it's a comment about the work that we do, it may motivate others to look at more of these. That is our job, to figure out ways to get more people to look more at more of these lessons. So thank you for being here with us. We do appreciate it. You keep us going. So all the best.